Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week I talked about keeping an eye on the German DAX. And firstly, as a broad measure of European equity sentiment, the DAX has mostly traded sideways since my last show in a relatively tight range and is down less than 1% since this time last week. And now that is either a sign that the recent rebound in the German DAX and European equities more generally is pausing for breath before the next leg higher, or it's running out of steam altogether. Now, it's a similar story with the S&P 500 over in America, albeit a slightly more positive one, as the index is up just over 1% since my last show. But once again, the rebound has stalled. And from a purely technical analysis perspective, this pause was always going to be expected, with equity markets having rebounded so far and so fast from the post-evasion lows. The S&P 500, for example, is up over 7%, while the DAX is up over 11%. We are seeing them hit resistance points. Now, if you recall, resistance from a technical analysis perspective is a level or price that an asset or index has trouble breaking above. Now, these are relatively easy to spot if you look at the chart of any index. So for the S&P 500, for example, that level has been 4,100, while for the DAX, it's struggled to break above 14,500. And both levels have been tested, but so far have proved too difficult to crack. If either threshold is breached to the upside, then the rebound will likely have further to run. Furthermore, both of these levels lie just above their respective indices 200-day moving average. Now, if you recall, a close back above these levels would be seen as bullish, while remaining trapped below the 200-day moving average is generally considered a bearish sign. But while equity markets may have stalled for a time, or until at least we find a catalyst or encounter a catalyst that sparks a move higher or lower on equity markets, many analysts are actually scratching their heads to try and work out why equity markets have proved so resilient. I mean, particularly when you consider the economic backdrop hasn't changed. We've got rising inflation, signs of slowing economic growth. I mean, the war in Ukraine is still raging, although UK media reports suggest the Russian advance has stalled. But we've also got central banks tightening and raising interest rates. So they're tightening monetary policy. And in particular, I'm talking about the Federal Reserve in America and also the Bank of England. But we've also got the ECB implying that they're going to do it, even though they are one of the more dovish central banks. But rather than equity markets faltering, which they've done previously at even the hint of tightening of monetary policy, they've continued to show signs of strength, even in the face of rising commodity prices. And just to reiterate that, the price of a barrel of oil, that's Brent crude, is back above $100. Now, whether it's complacency or justified confidence from equity markets, the bond market has done anything but stall this week. In fact, following last week's Federal Reserve meeting and a series of hawkish soundbites from Jerome Powell, who's the chair of the Federal Reserve, he essentially said that the Fed would tighten monetary policy as fast as it needed to. We saw the 10-year US Treasury yield accelerate higher, hitting 2.41%, which is up from the 2.2% we saw last week. Now, this was the highest level in 3 years. And don't forget that when bond yields rise, it means that the value of the bonds fall. But it's not just a US phenomenon. The FT reported that the Bloomberg Global Aggregate Index, which is a broad gauge of government and corporate bond levels around the world, has fallen over 11% since the peak in January 2021. So these are historic moves and greater than anything we saw during the financial crisis. Not only that, they are the biggest moves we've ever seen on that particular index, which goes back as far as 1990. It means that the bond portion of any portfolio has been hammered in 2022. Not only that, but on a number of occasions this week, we've seen bond and equities move in sync. So when equities have tumbled, so have bonds and vice versa. Now that's not normal. Now, the bond market is clearly still wrestling with the idea that central banks are about to begin tightening monetary policy aggressively. Now, yields on longer dated bonds are falling and in some instances are lower than those on shorter dated bonds. Now, this has been seen in some parts of the US Treasury market and is known as yield curve inversion. And the only reason why you would want to loan the US government money for longer, but at an effective lower interest rate, is that you think yields will fall in the future. Or in other words, the Fed will raise interest rates too soon, and that will cause the post-pandemic economic recovery to stall, and then they will be forced to cut interest rates once again in order to support the economy. So in other words, the Fed is about to make a huge policy mistake if you believe what the bond market is saying. Now, the moves in bond markets this week suggest that the school of thought is becoming even more entrenched that the Fed will make a mistake along with other central banks around the world. And with so much uncertainty, it's as if bond and equity investors are driving into fog. Now, bond investors have whacked on their hazard lights to warn others about the dangers and to avoid a potential crash. Meanwhile, equity investors have accelerated into the fog, ignoring all the fundamentals, certain it's going to be sunshine and blue skies just up ahead. Now, the trouble is, we don't know who is right or who is wrong, but the likelihood is that one or other of them is likely to see a crash, and they can't both be right. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, via Twitter, money2themasses with the number 2. You can find me on TikTok, Instagram, Facebook, and of course, don't forget to subscribe to our YouTube channel.